Welcome to The Property Code. I am Nick, and today we are talking about something that is quietly reshaping residential investing as we move through 2026, why mid-term rentals are outperforming Airbnbs for savvy real estate investors right now. Before we get into the story, I need to anchor the demand you are seeing in search. I do not have your screenshot in this chat, so I cannot quote it directly. But the most common high-intent searches tied to this topic in 2026 cluster into four buckets. First, people search mid-term rentals and corporate housing because they want longer stays without going fully long-term. Second, they search Airbnb regulations and short-term rental bans because rules keep tightening in many cities and enforcement is getting real. Third, they search travel, nurse housing, and furnished rentals because demand is tied to healthcare, corporate relocation, and life transitions. Fourth, they search how to furnish a rental and how to price a mid-term rental because the operational playbook is different. Consider that demand mapping a working hypothesis. You can align your script to even without the exact screenshot. Now the story. Meet Ryan. He is 39, lives in Tampa, and thought he had built the perfect Airbnb machine. 2 houses near the water, 1 condo near downtown, professional photos, dynamic pricing, smart locks, cleaners on speed dial. His calendar looked full, his revenue looked impressive, and his friends treated him like he cracked the code. Then 2025 rolled into 2026, and the rules changed around him. Not everywhere, but enough to make the business unstable. A city meeting introduced new registration requirements. A neighbor filed complaints about noise and parking. Insurance renewals came back higher than he expected. Cleaning costs jumped. Platform fees felt heavier. Occupancy became more seasonal, more volatile, more sensitive to reviews and algorithm shifts. Ryan was not losing money, but he was losing control, and control is the real asset. One night, after a guest canceled last minute and his cleaner still charged him, Ryan opened his laptop and ran a simple comparison. What would happen if he stopped chasing weekends and started chasing months? That was his pivot into mid-term rentals. Mid-term rentals sit in the space between a hotel and a traditional lease. Usually furnished, usually utilities included, usually stays measured in weeks or months. The tenant profile is not the bachelor party crowd. It is traveling professionals, traveling nurses, corporate relocation, insurance displacement, families renovating their homes, people in divorce transitions, people waiting for a home purchase to close. These tenants do not want a party house. They want stability, privacy, a kitchen, and reliable internet. They are also willing to pay more than a typical annual tenant because they are buying flexibility and convenience. Ryan's first mid-term experiment was not complicated. He took the condo near downtown, removed the aggressive weekend pricing, and listed it as a furnished monthly stay. He targeted professionals. He offered a clean, predictable package, furnished, utilities included, internet included, one simple monthly rate, one simple deposit, clear house rules, no events, no parties, quiet hours, minimum stay. The result surprised him. His nightly rate was lower than peak Airbnb weekends, but his vacancy dropped. His turnover dropped even more. Instead of constant cleaning, linen changes, and key issues, he had one move in and one move out every few months. Fewer problems, fewer messages, fewer emergencies. His revenue became smoother. His stress dropped. This is why mid-term rentals are outperforming Airbnbs for many investors in 2026. It is not because short-term rentals stopped working. It is because mid-term rentals reduce fragility. Let me explain fragility in plain language. A fragile rental model breaks when one variable changes. Regulations tighten, insurance spikes, tourism dips, a platform changes its algorithm, a new hotel opens nearby, reviews take a hit. If your entire business depends on high occupancy at high nightly rates with constant turnover, you are operating a high sensitivity machine. Mid-term rentals absorb shocks better because the income is contracted for longer periods. You are not reselling the same nights over and over. You are selling a block of time to a tenant who values stability. That changes the entire risk profile. There is also a regulatory advantage. Many cities that restrict short-term rentals define them by length of stay. That definition varies, but the pattern is consistent. Longer stays are often treated differently than nightly stays. Midterm models are not a magic legal loophole, and you still must comply with local rules, but in many markets they are simply less controversial. Neighborhoods fight party houses. They do not fight a traveling nurse who parks once and leaves in the morning. Ryan saw another benefit immediately: wear and tear. An Airbnb can feel like a public restaurant. Different people every few days, different habits, different respect levels. Midterm tenants are living. They care more. They settle in. They treat the place like a temporary home, not a weekend playground. That reduced Ryan's repair costs and extended the life of his furnishings. But midterm rentals are not passive. They require a different operating system. Ryan had to learn new fundamentals. Furnishing is not decoration. Furnishing is product design. You need durable couches, not aesthetic couches. You need a real desk, not a cute table. You need fast internet that actually works. You need a kitchen that can handle daily use. You need simple, repeatable inventory. You need backups. You need a process for maintenance without disrupting the tenant's routine. He also had to learn screening. Airbnb screening is reviews and instant booking settings. Midterm screening is closer to traditional leasing. Income verification where appropriate. Background checks where appropriate. Clear lease terms. Deposit handling. Identity confirmation. Ryan built a simple screening flow and stopped accepting tenants who felt uncertain. In midterm, one bad tenant can cost you months, so you trade quantity for quality. Pricing is another difference. In short term, you win by maximizing revenue per night. In midterm, you win by maximizing revenue per month while keeping vacancy low. The pricing sweet spot is where your rate is high enough to justify furnishing and utilities, but fair enough that you attract stable professionals who stay longer. Ryan learned to stop competing with Airbnbs and start competing with furnished corporate housing and extended stay options. His real competition was not the party house down the street, it was the furnished unit near the hospital, the relocation apartment near the corporate office, and the insurance displacement inventory in the area. In 2026, the demand drivers for mid-term rentals have expanded beyond travel nurses. Healthcare remains strong, but corporate travel has evolved. Projects run for months. Contract work has increased. People relocate more frequently. Life transitions are more common, and housing transactions can take longer in certain markets, creating a natural gap where people need a furnished place for a few months. Ryan's second property conversion was one of the houses. This time, he went further. He designed it specifically for a midterm tenant, a proper workspace, blackout curtains, smart but simple, durable floors, extra storage, a quiet, calm vibe. He marketed it as a home for professionals in transition, not as a vacation destination. His average stay length increased. His operational workload dropped again. This is the hidden truth. Mid-term rentals do not always beat Airbnbs on peak revenue. They often beat them on risk-adjusted returns. That is what sophisticated investors care about. Not the highest possible month, but the most stable year. There are cons. You need more capital upfront for furnishing. You must understand local landlord-tenant rules. You need a strong lease. You need a plan for utilities and maintenance. You need to handle furniture depreciation. And you need to accept that the growth is quieter, not flashy. But Ryan did not want flashy anymore. He wanted predictable. By late 2026, his portfolio looked different. One property remained short-term because it still performed well and the neighborhood supported it. Two properties shifted to mid-term. The condo became his most stable cash producer. His stress dropped. His calendar stopped feeling like a daily battle. He stopped managing constant turnover and started managing a real housing product. If you are an investor listening to this, the takeaway is simple. In 2026, smart real estate is less about chasing the highest gross revenue and more about building resilient income streams. Mid-term rentals are outperforming Airbnbs for many operators because they reduce turnover, reduce platform dependence, reduce regulatory friction in many markets, and smooth cash flow. The right move is not choosing one model forever. The right move is building flexibility, a property that can operate as long-term, mid-term, or short-term depending on regulations and demand is a powerful asset. Design your acquisition and renovation decisions with that flexibility in mind. Ryan did not become a better investor because he found a new hack. He became a better investor because he traded volatility for control. That is what savvy investors do when the market shifts. They do not complain, they adapt.